Wall Street is preparing for what could be a very tough day after a worldwide market sell-off. We've seen all the indices, the major indices, down in Asia and Europe. We're joined by the head of BlackRock's Global Rates Investments team, Eric Pellicciaro. Also with me, of course, John and Dom for this conversation. Eric, what do you think this commodities sell-off is about?
I think commodity prices have reached a tipping point where you're suddenly at a place where prices got so high that it's impacting real hard economic data. When you see that happening, speculation in commodities goes into a new phase because it's no longer that simple to assume that prices can keep going up. Suddenly the demand levels start coming down.
So the speculators are being flushed out.
The speculators are being flushed out. The impact on real growth forecasts is coming down because the realization of, boy, it's going to be hard to achieve a lot of growth with commodity prices here.
Weren't we saying that same thing a while back, too, that if commodities surged, that it would hurt the economy? I mean, I think people knew that, did they not?
People should have known that. I'll tell you, I hadn't seen it in the data until March and April, and I think that was the realization. Look at the claims data. Look at some of the ISM survey data. It's been a big shift. And I'll tell you, talking to most of commodity traders, it's very hard to know where that tipping point is. I think the market's found it, and I think we're in a new reality.
Is it the data, but also the expectation that then we're going to see rising interest rates?
No, I don't think it's that. I think QE2 ending is a really big deal as well. So when you couple the two together, geez, I've slowed down my data. I've got QE2 ending. Liquidity is going to be taken from me. Inflation expectations may actually come down, which should be supportive of bond prices. I think you get the opposite effect.
Well, talk about the self-correcting mechanism, right? If commodity prices do come down, that does provide fuel for further economic growth, right? So in this, is it about trying to find an equilibrium here? We know a lot of people are trying to flee these commodities, but eventually all of that cheap gas, cheap oil does give you a basis for a good economy, right?
That's exactly right, with the exception of you're in a sixth quarter of an expansion, and we haven't exactly had blockbuster growth. We shouldn't be dealing with this now. We shouldn't be in this kind of cycle between commodity prices and growth, and commodity prices hurting growth. It's a lot of fundamental.
It should be an exception? It should be outside of it?
We should have had more exceptional growth within the U.S. to get to this stage. So the fear is, boy, at 2% GDP, 2.5%, 3%, I mean, we're already having these problems.
Eric, the comments that you're making would suggest maybe you think people should be getting into treasuries, but Dom's got the stats here on what people polled by Bloomberg think about treasuries. They don't want to own them.
No, they think rates are going higher. They're saying sell treasuries, but at the same time, they're reducing their exposure to all kinds of debt, corporate bonds. They're reducing municipal bond exposure. So what's the role of these bond markets going to play in the overall picture for financial markets here?
Well, treasury prices have moved very closely with inflation expectations. And inflation expectations and speculation on inflation was rising during the whole QE2 process. My gut is, and we're seeing this in our business, my gut is that as you get closer to the end of QE2 and you get into the third quarter, you've seen the shift in the data, people may start coming back into treasuries for that reason.
Where would you be buying then?
We'd be focused more on the back end of the curve. Longer rates will be more impacted by lower inflation expectations. We think the front end at these levels is probably a little bit full, maybe where it's supposed to be or fair, and the back end looks a lot cheaper.
President Obama says that the biggest headwind for our economy is the housing market. So if we do see that, if higher rates start to happen, perhaps in those 30-year mortgages, does that perhaps put even more of a headwind on the U.S. housing market?
Absolutely. That's why it's self-correcting. As you mentioned, it's organic. We can't have these rates rise because as it rises, it's going to hit the data back down. Right? So we're kind of in this cycle where you need low rates. It has to be sustainable. Final thing is if you look at the picture within fixed income, yeah, Treasury supply is very high, but credit is very low. So in aggregate, bond supply is not that high. And then you think about what the Fed is taking out, boy, you're not left with a lot of bonds.
And so you're going to see companies still issue bonds then?
That's right.
Even if at the end of QE2 and maybe interest rates might rise by the end of this year.
That's right.
For corporate America. That's
right. And in corporate America, it may actually be in better shape than an equity market, which is a more levered play. In corporate America, 2 to 3% growth with manageable inflation isn't bad.
Quick yes or no here. Is there a QE3?
No.
To put it simply.
Yeah, not now.
Not with what's been happening with just all those inflation expectations with QE2. Eric, thank you.